So, hello again. This is the first presentation in the world of macroeconomics. Now we start thinking about the bigger picture of macroeconomics. So just before we get into that, a lot of people who take micro and macro and then after the fact tell me that they really weren't sure what the difference was. So let's maybe put that to bed right at the beginning. And so really the name should give it away. You know, the word micro just means small and the word macro means big. So in microeconomics, you deal with individual markets or individuals' preferences. So obviously an important component of microeconomics would be the work you did on demand and supply. And in those instances, you would have been looking at demand and supply for individual goods or services, so at the market level. So, for example, demand supply for shoes, demand supply for pizza, demand supply for gasoline, markets for going to the movies, or a market for buying bread, whatever it might be. So we're looking at small individual markets. Whereas in macroeconomics, we're dealing with the bigger issues. We don't look at individual markets, but rather we look at the whole economy. So we're not interested in the amount of cars manufactured in the United States. We're interested in the total production of everything produced in the United States. And in terms of prices, we're not looking at how prices of one individual good fluctuate over time. We're looking at the price level in general, which is what we call the inflation rate. So that's something we'll look at in the next presentation. So basically with microeconomics, you're looking at small individual level analyses. With macroeconomics, we're thinking about the bigger aggregated economy. So what aggregation simply means is that we just combine all those individual markets into one overall market. So we look at the United States economy as a whole rather than individual markets that make up that economy. So when you think about the national economy and we look at macroeconomics, there are really three variables that help us identify how an economy is doing. And those are gross domestic product, which we abbreviate to GDP, inflation, and unemployment. So we'll look at inflation and unemployment in the next presentation. So the focus of this presentation is really to look at gross domestic product and explain, first of all, what it is and how it's calculated, but then try and give some understanding to why it's so important and how it can tell us about the performance of a national economy. So what is GDP? So maybe I'll start by giving you a standard textbook definition of GDP, and then I'll break out that definition and try and look at some of the components to try and give us a better understanding of what this definition means. So most textbooks would define GDP as something like a measure of the dollar value of all final goods and services produced in the United States over a given period of time. So to redefine that, it is the total market value of all final goods and services produced in the United States within a year. And so there are, three or four key components to that one sentence, that one definition. So first of all, just to break out that definition a little bit, we only count final goods, not intermediate goods. So what a final good is, you can think of a final good as the good that you go and buy off the shelf. So as I walk into a supermarket and I pick up bread, that's the final good. Or if I go into a car lot and buy a new car, that's the final good. An intermediate good is a good that's produced that goes into making another good. So we only count the final goods. We do not count the value of these intermediate goods produced. And the reason why is that it avoids what's called double counting. If we included the value of intermediate goods, the overall GDP number would just be too big. And so, to try and give you an example of this, you can see just this table that looks at 3 different companies. You can imagine a small economy somewhere with only 3 companies. And we have company A, B, and C. Company A produces microchips. And each year, or let's just say last year, 2013, it produced 10 microchips. The price that it sells its microchips at are $20 each. So in terms of the value of production to just that one company, so last year, company A produced 10 microchips, selling at $20 each. That's a $200 value of production for that company. The production of that company's good was worth $200 in the marketplace. Then we had company B. And company B makes circuit boards. And company B, in manufacturing circuit boards, buys those microchips from company A because they need the microchips as a component in producing the circuit board. And company B last year also produced 10 circuit boards, so it needed those 10 microchips to go into producing those 10 circuit boards. And the selling price of a circuit board, let's say, was $50 each. So the 10 units at a $50 price generates a $500 value of production for those 10 circuit boards last year. And then finally we have company C. Company C produces televisions. And company C buys those 10 circuit boards from company B as a component in producing their TVs. And company C produced 10 TVs last year, sold them for $200 each, producing a value of $2,000 for that particular good. So when you look individually at the 3 companies and the value of their production, it's often tempting in answering the question, well, what is the value of GDP for this economy, to add those 3 numbers up and get a value of $2,700. But that wouldn't be right. Because again, what we're only interested in is the value of the final good. In this case, the final good is the TV. Because think of the value of a TV. When we're valuing that TV, the value of the circuit board and the microchips that have gone into producing the TV are already in there. So that $20 microchip and the $50 circuit board is already a component within the $200 TV. So the value of those 2 other goods are already counted when we're thinking of that $200 TV. So the value of GDP for this economy is $2,000. Again, we only include the value of the final good that goes to market. And again, we do this to avoid double counting. Something else. Only goods passing through markets get counted. Some transactions are not counted, they are excluded. And the obvious example here would be illegal activities. In most economies, the US included, there are several underground economies, illegal activities that do not get included in the calculation of GDP. For example, in most states, the sale of marijuana is illegal, so any production and sales of such an illegal product would not be included. Clearly, nobody's going to disclose the sale in the first place. So any illegal or underground economies, the value of that production, which may be very large, does not get included. What about secondhand sales? So, if you think about it for a minute, should secondhand sales be included? think about what the second-hand sale is involving. Again, it's something that happens very often. You can go to, obviously with the internet, different sites will advertise the sale of the second-hand goods. But in terms of the GDP calculation, we would not include the value of any second-hand sales. And that's simply because, for the example there of the bike, the value of the bike would be included in GDP in the year in which the bike was produced. The bike wasn't produced twice, it was just sold for a second time, or a third time, or a fourth time. It doesn't matter how many times the bike is subsequently sold, it was only produced once. So it only gets included in the original year in which the good was produced. Other activities not included, and important activities, things like housework, DIY repairs, leisure time, all things that won't get included in the GDP calculation. So, for example, housework. It's quite common that one parent might stay at home looking after the children. It's a very valuable contribution to society. Certainly nobody would argue that there wasn't any value attached to it, yet it's not included in the GDP calculation. And the same with DIY repairs in the home or the enjoyment of leisure time. So, I'll give you a quick recap then. So what is GDP? Again, it's this dollar value measure of all the goods and services produced in the US over time. And so, maybe another way of thinking about it. Imagine you could walk into a store today and ask to buy everything that was produced in the United States in a given year. So I would walk in and I would say, I want to buy everything that was produced in the United States last year. How much would that cost me? How much would I have to pay for that? So the storekeeper would go in the back, think about it for a minute, come out and say, okay, that would be $16.2 trillion, please. That's a big number. 16 trillion is essentially 16 with 12 zeros. That's what that number means. When we look at the GDP number, it's this dollar measure of everything that gets produced in an economy over a certain period of time, and often, for the sake of this course anyway, we think about that time period as being 1 year. So, 16.2 trillion was the GDP in the latest figures that we have, still 2012 figures. And so if you compare that number to the rest of the top 10 nations, you can see the US still is approximately twice, or produces twice the value of production that its next competitor, if you like, China does. So the US has the highest level of GDP each year, and you can see from this top 10 list that China, Japan, and Germany and France, it drops off fairly quickly, and then you've got from sort of UK to India as being around about the $2 trillion mark. So, hopefully that gives you some intuition about what GDP is. And so what we want to look at is, well, how do you measure it? And there are essentially two approaches. But of the two, we're going to focus exclusively on the first one. It's called the expenditures approach. And so when you think about one good, like the value of a car produced, well, how do we measure the market value of that one car that was produced? Well, there's a couple of ways to do it. One thing we could do is just find out how much somebody paid for it. So how much did you spend on that car would give you the idea of the value of the good produced. Another way you could do it is that you can add up the wages, the rental interest, and the profit that were created in producing the car, and that's called the income approach. However, for me, the most intuitive method, and the one that's most applicable because it really gives us a better understanding of what's called the aggregate expenditures model, which is the first model we'll look at that graphically shows us how we calculate the performance of a nation. The expenditures approach is just more intuitive. So essentially what we do, and we're going to spend much more time looking at this, but essentially what the expenditures approach does, it adds together all the spending on final goods and services produced in an economy over a given year. And so when we do that, we're just adding up, well, how much do people spend on these goods? That tells us what the value of the production was. So to do this, we break up the economy into the 4 different sectors that we look at as the 4 spending sectors of an economy. And to do this, I think a good place to start here is to show you what's called a circular flow diagram. And most intro to macro textbooks will have a circular flow diagram, but they can get a little complicated quite quickly. So what I like to do is just break it down and show you the 4 main sectors and how spending flows between those 4 sectors. It's certainly not complete. We don't show all the spending, but it gives you a general idea of the circular flow and how these different sectors interact with each other and what these spending flows are. So first up, we have the first 2 sectors of an economy, where on the right-hand side you see households. So that's the sector we all belong to. We're all there in the household sector. On the other side, you've got the business sector, where all the firms and the factories are housed. And there's clearly a daily interaction between these 2 sectors. So I'm going to draw some arrows here, and what you can see, the arrows or the flow, what these are depicting is the flow of money going around an economy. So here we have 2 arrows showing there's a flow of funds coming out of the household sector and going into businesses. So what does that represent? Well, technically, that flow of funds goes through what we call the product market. And this flow just represents everyday spending from individuals like yourself and me. Every day we go out there and we buy stuff. And of course we're buying things that have been produced in the business sector. And so technically, the way we would look at it is that we go via the product market. So all these products are there in this product market, and we go and we exchange our money for the product. So it's a place where households and businesses meet. You just think of that as demand and supply. So behind the scenes in this product market are all those individual demand and supply diagrams you would have looked at in your micro class, forming the equilibrium price so we know how much to pay and making the transaction happen. So that first flow of money is just funds coming out of households to buy goods and services, and that flow of funds goes back into the firms. So we then have a second flow. If you like to complete this circle, we have this flow of funds going from businesses back into the households. And again, technically, that flow also goes through a market, and we call that the resource market. So what does this flow of funds represent? Well, where do we get our money from to be able to go to the product market and buy goods and services in the first place? We offer ourselves as a resource. We are a labor input into the resource market. So we go to work and we earn money. And that generates the second flow of income coming out of businesses into households via the resource market. So the resource market is where we have the labor demand and supply, where we're supplying our labor. Companies on the demand side forms this equilibrium price, which is the equilibrium income, how much money you get paid, and that completes the flow. So we have income flowing into households, creating spending that comes out. So we have our first level of spending here, and we call it consumer spending. So again, this is the flow of money coming from the households into businesses as we buy everyday goods and services. And we abbreviate consumer spending with the letter C. C for consumer spending. And what generates that spending is income. And we abbreviate income with the letter Y. You'd think they'd use I, but I is already taken with investment spending, as we'll see soon. So income is abbreviated with the letter Y. So that's the basic flow. Income goes into households from businesses, creates spending that takes money out of households and back into the businesses. So that's the main general circular flow of an economy. And here we have the first two sectors interacting with each other. So what other sectors do we have? Well, I'm going to put it right in the middle. Right in the middle, we've got the government. And the government is our third sector of the economy. And again, the government interacts with both households and businesses. You could probably think of several flows of money that go between these sectors of an economy. For example, we have a flow right here, a flow of money coming out of households to the government. Think of money that leaves your household and goes to the government. Of course, we call those taxes. So the government collects tax revenues from us. And at the same time, there's a reciprocal flow as money flows from the government back into households. And we put those under the general description of transfers. So, for example, welfare or unemployment. If I'm not employed, I can collect unemployment, and that's a flow of money from the government into households. We could also have a flow from the government going into the product market, as the government also purchases goods and services from businesses, and that's another flow for us to think about. That's called government spending, or sometimes government purchases, which we abbreviate with the letters G. So, as governments build new roads, or provide a library, other public services, they are purchasing these goods and services from the business sector via the product market. That's another flow of money, and the government spends a lot of money every year, and we capture that with the letter G, government spending. Again, you can think of other flows that are applicable in this diagram, but I'm just trying to keep it somewhat basic, not to overcomplicate the diagram. And then you can also think of a flow going from the businesses also to other businesses via the product market, because businesses buy goods and services from other businesses. And we call that business spending, or sometimes investment spending, and it's abbreviated with the letter I. So investment spending, as we'll describe again in a few minutes, represents businesses buying plant and equipment and machinery from other businesses, essentially to increase the capacity of their company. And again, this represents a big flow of money every year as companies invest in equipment, machinery, and things of that nature. And then finally, we have our last sector of the economy, which I'm going to sort of stick outside of the circular flow diagram to represent that this sector is outside of our national boundary. And this is the foreign sector. Because, of course, we're not constrained to just buying goods and services from the United States. If we live in the United States, we can go out to the rest of the world and buy goods and services produced in other countries. So there's a flow of money that goes from US households out to the rest of the world to purchase their goods. Of course, we call those imports. So there's import spending. So think of a Sony TV or an item of clothing that's produced outside the US, BMWs, French wine, all goods that we can go out and buy, produced in other countries. That represents import spending. Conversely though, of course, the rest of the world can come to the US and buy their goods and services. And those are called exports to the United States. So these are goods that leave the United States but are purchased abroad. So if someone from France purchases some Levi jeans produced in the United States, that's an export to the United States. That represents a flow of money coming in to the US product market from the foreign sector. So those are the basic flows of our economy. And these are the flows that are going to help us understand how an economy operates. And again, as you can see, there are these four main sectors: the household sector, businesses, the government sector, and the foreign sector. And they all spend money. And so the expenditures approach to measuring GDP traces the flow of money from those four sectors. So what we need to do is to understand those four levels of spending and define them just so we're comfortable with what each represents. So the first level of spending was consumption spending or consumption expenditures, again abbreviated with the letter C. And so there's that first flow of money from the household sector into the product market. And so C, consumption spending, represents expenditures by households on both durable goods, goods that last like cars and TVs, and non-durable goods, things like bread and milk that don't last, and also services. So you go to get your hair cut, or you go and stay in a hotel, or you pay a lawyer, and those are services that you've purchased. So these represent all levels of expenditures that we would house under consumption expenditures. Also includes spending on foreign goods produced, so imports into the US, and it's the most important of our four levels of spending. So again, when we add up these four levels of spending, it's going to give us the GDP for that year, for that nation. And typically, consumer spending, C, constitutes roughly 70% of all the spending in the economy. So those four levels of spending: consumer spending, the investment spending, government spending, and what we'll call net export spending. Consumer spending represents 70% of that total. So it's by far and away the largest component of the four levels of spending, therefore the most important. So often if you're reading an article about the economy, it will start with consumer spending and what's happening to that level. So to give you a breakdown of consumer spending, in any given year, roughly about 10% of consumer spending are on durable consumer goods. So the strict definition there is having a lifespan of 3 years or more. 30% of C goes to non-durable goods, such as food, clothing, and gasoline. So the remaining 60% are for services, which we frequently refer to as a service economy. The second level of spending, again, we call business spending or investment spending. Sometimes the word investment might be a little misleading, because when you use the word investment, sometimes we think about individuals investing money in the stock market. That's not what we mean here. Investment spending is strictly spending by companies. So we can often call it business spending, and includes any spending by companies, as I mentioned, just to increase the capacity of the company. So when a company goes out and buys a new machinery or a new delivery vehicle or a new piece of equipment or maybe a new warehouse or a new plant, anything to increase the capacity of the company, that all constitutes investment spending. Also, within investment spending are changes to a company's inventory. So I've got a couple of scenarios there. If a company has more inventory at the end of the year than the beginning of the year, then this must represent output that they have produced but was not sold that year. So we want to add that back to that year's GDP. Because remember, GDP is trying to capture the value of goods produced in a year, not necessarily sold, but produced. So if a company at the end of the year has more inventory than it did at the beginning, then that's because they produced goods that year that weren't sold that year. So we would add the value of those goods back to the GDP calculation. Conversely, if a company has less inventory at the end than the beginning, then they must have sold goods in that particular year that weren't produced that year. So the value of those transactions would be taken away from that year's GDP, again, because it's going to reflect output sold that year but was not produced that year. So that output would already have been included in the previous year, or whatever year that particular output was produced in. A third level of spending would be G, government purchases. Again, each year the government spends a significant amount of money on public services, providing the military, roads, schools, libraries, etc. We need to include all of those funds. What we do not include, that I mentioned on that circular flow diagram, were are transfer payments, things like unemployment benefits or social security. And if you think about why you wouldn't include that, again, think about what GDP is trying to measure. GDP is measuring the value of goods produced. Where if you're collecting unemployment benefit, you're not providing production in return. So any transaction that doesn't have a flow of production going the other way would not be included. So unemployment benefits or social security or welfare, these are transfer payments from the government, do not get included. There's no production going in the other direction. And finally, we have net export spending, which again comes from that fourth sector of the economy, the foreign sector. And as I mentioned, each year Americans spend money on goods and services produced in other countries. We call those imports into the US. At the same time, residents of foreign countries can purchase goods and services from the US. We call those exported goods. So rather than dealing with both spending on export and imports, we just take a net amount. So we calculate this XN level of spending, which is spending on exports, X, minus spending on imports, M. So XN represents net export spending. So if you think about that little calculation, spending on exports minus spending on imports, each year in the US, and for a lot of advanced industrialized nations, that level XN, net export spending, is negative, because these nations, like the US, tend to import more goods than they export. They tend to buy more goods from other nations than those nations buy from, in this case, the US. So typically every year, net export spending in the US is going to be negative. So there we have the four levels of spending in the economy coming from those four different sectors. And these four levels of spending represent the amount of money spent on goods and services produced in the US over a specific time period, like a year. So we use those four levels of spending in the expenditures method to calculate GDP. So if we add up how much money is spent in terms of consumer spending, plus investment spending, plus the government purchases, plus net export spending, that gives us the value of GDP for that specific time period. So we've got this little calculation here that we'll be using and referring to a lot throughout the rest of the course, that GDP is equal to C plus I plus G plus XN. The value of all goods and services produced in the United States is equal to how much money was spent on those goods and services. And again, how much money was spent comes from those four sectors. So we have those four levels of spending. So we just simply add them together to get the dollar measure for GDP over that period of time. So I believe the expenditures method, as opposed to the income method or approach, is just more intuitive and will help us when we're developing this first model called the aggregate expenditures model, help us to understand how we measure GDP and where it comes from. So again, just to show you this circular flow diagram, the expenditures method in calculating GDP, this is what it's trying to do. It's just tracing the flow of these four levels of spending through the economy. And so sometimes I think if you ever get stuck with an individual component that we're discussing, like if I'm talking about consumer spending, as we will in more detail, and you get stuck on, oh, what exactly is consumer spending again? Why is it important? Then maybe just go back to this diagram. This diagram, I think, provides a good overview of what's happening within the economy and how these spending flows are interacting with each other. So if we look at data for 2012, all these data are in billions. Then on the left-hand side, we have the approach that we're going to follow. So you can probably see straight away it's less complicated, but I also think more intuitive. So on the left-hand side, we have this expenditures approach. And so we just take consumer spending in 2012, about $11.2 trillion. We have investment spending, about 2.5 trillion. Government purchases, G, about 3.2 trillion. And net export spending, again, we see is negative 547 billion. If you add those four numbers together, you'll get $16.245 trillion, or $16,245 billion. That was GDP in 2012. So again, we calculate it by adding those four levels of spending together. You can see from the income approach on the right-hand side, of course, you're going to get the same number. It's just a different way of calculating the same thing. So we'll use the expenditures approach always in calculating our measure of GDP. One more thing to talk about with GDP is there's this issue of nominal versus real GDP. And I'll talk more about nominal variables and real variables after we look at inflation. But so far, as I've discussed, we've really been looking at what we call nominal GDP. So GDP is this dollar measure of production, but using these constant dollar values, there's problems in the nominal GDP calculation. Basically, nominal GDP represents units produced that year multiplied by the prices of the goods that year. So it's based on the prices that prevailed in the market when the output was produced. And as we'll see in a second in a table, that just causes problems. Real GDP, anytime you see any number that's real or a variable that's real as opposed to nominal, it means essentially it's taken out the effect of changing prices over time. So real GDP reflects production each year with the effects of prices and how prices have changed over those years taken out. So we use what we call this base year price in the calculation of real GDP. So here we have an example of, again, just a small economy. And what we see here is that we have a small economy that produces TVs. And we have 2 years of data. And so what I can see is that in both years, this economy produced 100 TVs. And in year one, the price of a TV was $300. But in year two, the price of TVs rose to $360. Well, I want to calculate GDP for both of those years. So, based on the data I have, I would take in year one and year two, the number of TVs produced multiplied by the price. And what that gives you is the nominal GDP number. That year's production multiplied by that year's price. So in year one, the 100 TVs multiplied by $300 means the value of production in that year was $30,000. In year two, the 100 TVs produced and a $360 price means the value of production that year in nominal terms was $36,000. So if I was just to show you the GDP numbers and say, what can you tell me about production in this economy? It's likely you'd say that in year two, this economy produced more than it did in year one, simply because the value of GDP is higher. And that would be an obvious inference to make. However, as we can see from the numbers that underlie that calculation, the production in both years was exactly the same. So GDP has risen, our nominal GDP number has gone up, but there hasn't been any increase in output. So nominal GDP can be misleading. Again, the suggestion is we've produced more because our value of GDP is higher. So ideally what we need is a measure of GDP that takes out the effect of changing prices, because it was the change in the price of the good over that 1 year period that gave us that somewhat misleading result. So a measure of GDP that takes out the effect of rising prices or changing prices is real GDP. So real GDP takes our nominal GDP calculation and then adjusts that for any price changes over that period of time. So we now have the table with a little bit more data on. Again, we have the same initial data with the number of TVs produced and the prices and the nominal GDP numbers. But now in the fifth column there, we have the GDP, what's called the GDP price deflator. And that is an index number that is generated based on changing prices over that 1 year period. I'll come back to what the GDP deflator and what this index number means later when we do inflation. But just for now, let's say we can calculate that. I can see it's 100 in year 1 and 120 in year 2. And we use that to calculate real GDP. We use that increase in the GDP deflator to take out the effect of rising prices on nominal GDP. So if you look at the real GDP numbers in the last column, when we make that calculation, and I'll show you how to do that in a second, you can see real GDP is $30,000 in both years. So when I look at those numbers, I make the inference that we produced the same amount in year 1 as we did in year 2. And that's the GDP that we would like to refer to. So as we move forwards, even though sometimes I might not say real GDP, we're always referring to real GDP. So a GDP level that has taken out the effect of rising prices. And again, we do that using this GDP deflator. So it's quite a straightforward calculation. Real GDP is the nominal GDP number divided by the GDP deflator times 100. So if I go back, I can see in year 2, I would take nominal GDP of 36,000 divided by the GDP deflator of 120 times 100 would give me 30,000. Obviously in year 1 I'd be dividing by 100 and multiplying by 100, so nominal GDP would be equal to real GDP in that year. So again, I would do it there for year 2 and I'd get the same GDP, real GDP number in year 2 as I got in year 1. So as I mentioned, this deflator is calculated in a similar way to what's called the CPI, and we'll discuss the CPI later when we look at inflation. So finally, while GDP is a reasonably accurate measure and very important to us, I mean, it's the key variable we use to understand how the economy is performing, it does have some shortcomings, as any estimate would. For example, certain activities, certain productive activities occur outside of the market and therefore are not measured in this traditional way. And so things like the value of leisure time, holidays and spending time at the weekends, these values are not included, but they obviously add value to the individual and to society via the satisfaction that we gain from taking a trip to the beach or whatever the leisure activity may be. So there's a value to this type of activity, but that's not included in the GDP measure. GDP also does not capture the full value of improvements in product quality. So it's a measure of production, but not necessarily a measure of the quality. So, an example that maybe we're all familiar with, a $200 cell phone purchased today is quite different to a $200 cell phone purchased maybe a decade ago. There weren't apps a decade ago. The cell phone is a far high quality piece of machinery today than it was for the same price 10 years ago. That change in quality isn't captured in this GDP calculation. As I also mentioned, there are large underground economies or illegal activities that don't get measured via GDP. And these activities can be, very valuable, but of course the recipients don't wish to report them to the IRS and pay taxes, so they're not reported. So again, it's not captured in this GDP calculation. Also environmental issues, so other non-economic sources of well-being. GDP really doesn't have a good way of calculating these values. So if we, let's say, a company can increase its production, but at the same time it's degrading the environment, it's polluting in the production process, then we would think of that as a negative. But that degradation of the environment isn't included in the GDP calculation, so we miss that. So in that sense, GDP would be overstating the value of production. So there are definitely some shortcomings to GDP, but again, it's the principal measure we use to capture the performance of an economy. And so we look at GDP over time to see how the economy is performing month by month by month. Is it picking up? Is it improving? Is it on the downside? Is the economy contracting? We look at GDP to help measure this.